Hello and welcome to this episode of Retirement Clarity Radio. Thank you for joining us. Shout out to my dozens and dozens of listeners all across the country. I am so glad that you're here. We are continuing this series on taxes, and the last 3 episodes have been about taxes, mainly based off my book, The Retirement Tax Bomb, How to Protect Your 401k from Impending Tax Increases and Create a Tax-Free Retirement. And today I'm actually going to be going through a worksheet that I created from this book called 6 Steps to a Tax-Free Retirement. And full disclosure, this tax stuff is tricky. I would not do this alone. I would work with your either CPA or certified financial planner, some kind of tax professional who can help you implement some of these strategies, just because we don't want any kind of unexpected tax consequence of anything that we talk about in this show, because maybe we make a mistake, maybe we overlook something that we should have considered. So I'm going to give you 2 resources. One, if you want to get my book about retirement and taxes, just go to freeretirementbooks.com. Again, that's freeretirementbooks.com. And then actually, I've got one more. I usually only give one, but I got one more for you. If you want this worksheet, that's just a PDF worksheet, and it just goes through these 6 steps to a tax-free retirement worksheet. Go to retirementworksheets.com, retirementworksheets.com, and then you'll see it listed there. All I need for those 2 is just short contact information, name, email address, and then I'll send you a PDF copy of whichever download you choose. Okay, let us get into this episode. It's titled 6 Steps to a Tax-Free Retirement. Now, even if you can't, let's say you go through everything in here, let's say you can't get a tax-free retirement, you can still lower your taxes in retirement. So one of those 2 choices. Neither is bad. Obviously, if we can get to a 0% tax bracket, that'd be amazing. If not, let's see if we can lower your lifetime tax burden. So let's just go through the steps together. I'm going to talk about what the step is, and then also why it's important. And then our next episode on this podcast is going to kind of be putting it all together. So if you're curious in terms of like, how does this all come together, you need to stick around, like, subscribe, whatever you do on these podcasts, make sure you come back next week. Okay, so step 1 is to calculate your tax brackets. Now, what is that? What is a tax bracket? Excuse me, I already misspoke. Calculate your tax buckets, not your brackets. Calculate your tax buckets. So we have 3 main tax buckets. The first one is our taxable buckets, and that is accounts that are taxed every year whenever you have income. So your joint account that you have with your spouse, an individual account that you have, your savings, checkings accounts, those are all taxable accounts. If you get interest or dividends or capital gains, you got to pay taxes on that. So taxable accounts is our first tax bucket. Our second one is tax deferred. This is probably the most common one. So just think of like your traditional IRA or your traditional 401k. Tax deferred accounts are not taxed when you earn the income, but they are taxed when you distribute the money. So tax deferred is our second tax bucket. And then the third one is tax free, which means that you will not pay taxes on the money in these accounts in the future. However, you might have to pay taxes getting that money into those accounts. So Roth IRAs are one big example of that. Also, another big example that I think is underused is something called the health savings account, which we'll get into later. But that can be a great source of tax-free money also. So why are these important? It's important, I talked about this in the book, is because you want to have the right amounts in taxable, tax-deferred, and tax-free buckets. You don't want everything in one bucket, as that's simply going to limit your options, and it's likely going to cost you more in taxes throughout your life. So the strategy that I discuss in this book, and I go into it in more detail, so pick up the book, but the strategy I discuss is to have around 6 to 12 months of living expenses in your taxable accounts. Then you want to ensure that your tax-deferred distributions roughly equal your standard deduction, so that you can take the standard deduction to eliminate the taxes you owe on those distributions. And then lastly, anything above that amount should go in the tax-free accounts. Again, it's a little complex strategy. Pick up the book and then work with someone to kind of implement all of this. But those are my rough guidelines and ideas around tax buckets. Okay, so step 2 is to know your provisional income as well as your marginal tax rate. Now, your provisional income is a measure that the IRS created to make taxes more confusing, and it is simply a measurement that the IRS uses to calculate how much of your Social Security benefits are going to be taxed. So we want to understand what your provisional income is. The second thing to know is your marginal tax rate, and that's the tax rate incurred on each dollar of additional income that you make. So in other words, what's the highest tax bracket that you pay on the last dollar of income that you make? So that very last dollar, that very last $10, what tax rate do you pay on that extra money? That's your marginal tax rate. Now, why are those important? As I said before, provisional income is going to determine whether and how much you're going to have to pay taxes on Social Security benefits. And your marginal tax rate is essential in determining whether it makes more sense to pay taxes now at your marginal tax rate, your highest tax rate, or delay paying taxes until later. Okay, step 3 is contribute to a Roth IRA if eligible. There are income limits, and so we'll get to that in one second. But what it is, an IRA is an individual retirement account that has certain tax benefits, and a Roth IRA means that you pay taxes on your income as you earn it, then you can contribute that money to a Roth IRA. The money is going to grow tax-free, and then when you withdraw it, under qualified circumstances, you can take it out without having to pay taxes on that money. Now, why is it important? The Roth IRA is a great way to get money in your tax-free buckets. It's going to give you tax-free income in the future. Beyond that, income, distributions that you take from Roth accounts don't count towards your provisional income, which means it could potentially help you in lowering or eliminating the taxes you pay on your Social Security benefits. Now, quick note, I'm recording this in the year 2021. I'm just looking at the 2021 contribution limits for the Roth IRA. Your modified adjusted, if you're single, your modified adjusted gross income has to be under $140,000 for tax year 2021. And then if you're married filing jointly for tax year 2021, your modified adjusted gross income has to be under $208,000. If you're confused on whether you're under those thresholds, please reach out to your CPA, some kind of financial professional, certified financial planner who can help you determine that, so you don't put money into an account that you're not technically allowed to put money into. Okay, next is step 4, and this is contribute to a Roth 401k, 403b, or 457. Now, a 401k, 403b, and 457 are all employer-sponsored retirement plans. So you can only access these plans through a job. And unfortunately, not all employers have a Roth option. So you do have to check yours if they have that available. But if they don't, ask. It's really not a hard or expensive change for your employer. So if it's not there, I would definitely encourage you to go ask them and see if they can do it. Now, if you do work at an employer that has this Roth option, this is a great way to contribute a large amount into the tax-free buckets. So as you might know, the IRA contribution limits are limited to $6,000. But with an employer-sponsored plan, the 401k, 403b, 457, you can actually contribute up to $19,500 into those plans. So you can get a lot more money into those accounts through your employer-sponsored plans than you could with an individual account like an IRA. On top of that, there's no income limitations into those contributions, so you don't have to worry about your income and contribute it into those accounts, unlike the IRA. So that's a great way to turbocharge what you can get into the tax-free accounts if you have that option at work, and if you don't, beg, bleed, see if you can get them to make that change. Very next is step 5, and this is make a Roth conversion. As I said before, do not do this without a financial professional helping you out. That's a big disclaimer on this whole episode. A Roth conversion is simply taking money that's currently in your tax-deferred accounts, your traditional 401k, and moving it into a tax-free bucket. So in other words, you take money from the traditional accounts and you put it into a Roth type account. Now, when you make this switch from traditional to Roth, the amount that you convert or move is considered taxable income, and it's going to create a tax liability for you in the year that you made the conversion. Now, why is this so important? A Roth conversion makes a lot of sense for a lot of people to get money into their tax-free bucket, especially if they make too much to contribute to a Roth IRA. and their employer doesn't have a Roth option in their retirement plan. In essence, what you're doing with a Roth conversion is you're locking in tax rates now, you're paying it now so that you don't have to pay them in the future. So if you think tax rates will rise in the future, as I do, and as I described in this podcast and in my book, then you should consider this strategy. But again, they're tricky. Make sure you work with a professional before you do them. And then also, you have to understand that you're paying taxes. You're going to have to pay extra taxes this year in order to kind of lock in those tax rates so you don't have to pay them in the future. So you have to have a plan to pay that tax bill. If you don't have a plan to pay the tax bill, then you're going to get a giant bill from the IRS. Then you're going to be upset at me. It's just going to be a complete disaster. So we're going to talk more about Roth conversions on this podcast, maybe towards the end of the year. But again, work with a professional, make sure you have a plan to pay your taxes, and then make sure it makes sense for you to pay those taxes now instead of in the future. And then our sixth step, our last step for today, is contribute to an HSA. An HSA is a health savings account, and you only get access to an HSA through your medical insurance when you have a high deductible health insurance plan. And so you have to have a high deductible plan, and then you're going to be able to contribute an annual amount into these plans that will pay for your health expenses when you need it. And so the income limits are up to, in 2021, it's up to $7,200 for a family. So that's how much you can contribute into an HSA. And let me talk about why it's important, because it's a really great strategy that I don't see enough people paying attention to. It is so important because if it makes sense for you, it offers a triple tax benefit that it's really hard to get anywhere else in the tax code. So when you contribute money into an HSA, you are allowed to deduct that money from your income in the current year. So it lowers your taxable income in the current year that you make that contribution. Then when you invest that money, it grows tax deferred, meaning that you don't have to pay taxes on it every year. And then finally, when you withdraw that money for a qualified medical expense, distributions are tax-free as well. Emphasis on qualified medical expense. You got to make sure it qualifies to take out that money tax and penalty free. So you can consider this money part of your tax bucket and use it for medical expenses in retirement. And you know, here's a word of warning for you. You will have medical expenses in retirement. So it's pretty safe to assume that you're going to have some kind of reason to need to use this money. And then you don't have to worry about these distributions bumping up your provisional income or any other type of income, so long as you use it for qualified medical expenses. Okay, and so these are 6 steps to a tax-free retirement. If you are not able to get a tax-free retirement, you still could be able to lower your taxes in retirement. Our next episode is actually going to be putting it all together. So I've given you the 6 steps, 6 things to think about, 6 strategies to consider. And then next week, I'm going to use a case study of Ricky and Lucy from one of my favorite TV shows growing up, I Love Lucy. And we are going to talk about what it would look like to actually implement these strategies to lower or eliminate your taxes in retirement. So make sure you come back to this podcast, like us, subscribe. And then if you want to get this worksheet, just go to retirementworksheets.com, and I will give you this document, which is also from my book, that you can go through and just have as a handy copy as you go about implementing these strategies, again, with the help of a financial professional. Okay, that's all I've got for today. Hope you all have a great week. Bye.
Thanks again for listening. As a reminder, you should consult with a financial advisor familiar with the specific circumstances of your unique financial situation before making any financial decisions. Nothing in this podcast is a solicitation for the sale or purchase of any securities. Any mentions of rate of return are hypothetical in nature and not a guarantee of future returns. Scott Newhouse, CFP, is an investment advisor representative of Forthright Finances, a California and Nevada registered investment advisor.